Maximize your profitability and streamline your operations with Optimal Blue's hedging and trading solutions. With Optimal Blue, you can automate processes, reduce manual errors, and cut administrative costs. Experience faster transactions and improved operational efficiency with tools like the Compass Edge Rate Sheet tool and Profitability Assistant. Stay ahead with real-time risk management and make informed decisions quickly. Our robust data connections ensure seamless synchronization, enhancing data integrity and operational efficiency. Unlock deeper insights with our advanced analytics and modeling tools, and benefit from the expertise of seasoned industry professionals. Optimize your competitive advantage and maximize profitability on every loan. Ready to transform your secondary marketing operations? Visit optimalblue.com to learn more.
Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
Welcome to Optimal Insights, your weekly source for timely market analysis and expert commentary from Optimal Blue. I'm your host, Jim Glennon, Vice President of Hedging and Trading Client Services at Optimal Blue. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keeping the industry informed. Let's dive into today's episode. Hey, welcome, gentlemen. Jeff, Alex, pretty good week going on here already on this Monday. We got a really fun episode today. Everybody, we're going to do a year in review. So we're going to review some happenings and some themes of 2024, some global themes, fun stuff that happened in 2024, but also some things that affected our industry, some things that directly affected the financial markets. First, we'll get into a couple other items. Just data-wise, kind of slow right now. Alex will get into some of the economic numbers, but just looking at some of the data that we curate here at Optimal Blue, the OVMMI, stubbornly flat 6.7. So conventional 30-year rates are being locked in right about 6.7 on average, really for the past couple of months. Volume's pretty steady and healthy, I would say, compared to this time last year, for instance. We're still up 20, 30% over December of 2023. So seeing decent numbers there, although a little bit of a fall off in the last week.
You know, rates did tick up at the end of last week more than anybody would hope, or perhaps limping into the end of the year just a little bit. I think we were all hoping for a downward trend in rates. And like you said, it's just been pretty steady the past few weeks post-election, if not a little bit of a tick up, unfortunately. So,
right. Yeah, we'll talk a little bit about how we've had forecasts all year for where rates would be, and we're pretty far above where we were forecasting back in January. But we are getting into the end of the year, so don't expect a lot of change in rates, especially with liquidity being pretty lean. That's something to beware right now as we go into the end of the year. A lot of vacation trade, a lot of holiday trade, so beware just slow volume in the capital markets. Of course, we have our summit coming up. Can't forget about that. Please register if you have not. Our summit is our annual conference, which will be in San Diego, February 3rd through the 5th. So we're making a push to get registrations finalized before the end of the year here. So please hit up our website, summit.optimalblue.com. And remember, there's a couple really high-profile speakers that'll be joining us, in addition to a ton of folks from our team and a ton of folks from the industry. But we still have Tony Hawk coming. Tony Hawk is going to be one of our main speakers, so really excited about that.
Yes, everybody's very excited about Tony Hawk. Come see him live and in person.
That's right.
Jeff,
all right.
Foremost.
Yeah, perhaps me first and foremost.
Jeff's going to be
first among equals. Yeah.
Well, we're putting together, finalizing some of our other panels. A lot of investors, broker-dealers coming in, some top originators, top capital markets experts. So really shaping up to put together some really good content over a couple of days in San Diego.
Yeah. Okay, let's check in with Alex, see what's going on in economic news.
All right, Alex. So we've got big day on Wednesday, last Fed announcement of the year, right?
Yeah, yep. No, it's time to close out the year from a FOMC perspective. They'll be meeting on Wednesday, the 18th. It's kind of business as usual, it feels like. We're heavily expecting a rate cut here, 25 basis points. Futures markets are showing north of 99% chance for a rate cut here. I think this is, it is baked in at this point, but, I'm already looking towards next year and kind of like where the start of next year is going to take us. In the past 3 months or so, we've had consistent rate cuts at each meeting, and they need to see these rate cuts feed into the economy. Same story as when we were seeing the opposite and we were seeing the rate hikes. It takes 6 to 8 months to start seeing the effects of those rate cuts in the economy. And so right now, and these are all subject to change, data dependent, but right now we're kind of seeing a pause for January, potential for an additional 25 basis point cut in March. And then it looks to be that they'll pause there for quite some time. Right now, again, these further out FOMC meeting future projections are harder to really glean any meaningful takeaways from. But right now, it looks like they'll pause through mid-year, if not into the fall of 2025. Looking at September likely as the first cut. So September 2025 after a March cut.
Yeah, that pausing there early in the year still leaves policy pretty restrictive, doesn't it? To where I guess we haven't really seen close to a 2% inflation number, so we're still fighting that number that's even stubbornly above 2.5, I suppose. But still, if we pause here or after the December cut, policy is still pretty restrictive, just in historical terms.
Yeah, historically speaking, especially recent history, it is still in a pretty restrictive space. That would leave us at 400 to 425 basis points with a March cut. And yeah, most people would consider anything north of 4 pretty restrictive. But like you said, inflation is still rearing its head. As we'll get into later, 2024 was kind of a year of raising inflation expectations from a 2% to maybe 2.5% is something you can expect year in and year out. And last week's CPI and PPI releases kind of reinforced in the short term at least that inflation hasn't gone anywhere. CPI came in at 2.7% year over year, and the core number was even higher at 3.3%. So that core number tries to exclude very volatile factors like fuel costs and such, but core remained north of 3%. On the most recent release. As Jeff was mentioning at the top of the podcast here, we did see some rate increases last week, which came in the latter half of the week when we were seeing those inflation readings. Yeah, we saw, I think it was 8 or 9 tick sell-offs each Wednesday and Thursday. And so each of those we could see 1/8 to a 1/4 point increase in rates with that kind of a sell-off price-wise.
Sure.
And this is definitely one of those announcements where, essentially baked in a drop in rates, right? But then depending on what the language is in the announcement, we could even see, short term, an increase in treasuries and mortgage rates, depending on, what language is, right? So you got to be watching the language of the announcement super closely. So that's where it can kind of get confusing with borrowers and, as you're trying to sell a rate, delivering a message to the market, right? They see, hey, the Fed dropped rates today. Why did mortgage rates go up?
Yeah, definitely. Yeah, I think it bears repeating, of course, that when the Fed cuts rates, it doesn't necessarily mean mortgage rates will be coming down. Any cut that we see on Wednesday is already baked in. The rates that you're seeing in the market are reflective of the market adjusting for 2 to 3 months down the line from now.
Yeah, so watch the language, as Jeff said. I think the market is still hungry for some sort of conviction in some sort of clear path that the Fed is on right now, and it still just seems to be very vague, very data dependent, very, certainly they're focused on unemployment now a little bit, not 100% on inflation, but there's still not a clear rate path.
Yeah, definitely. I think you see individual comments here and there. We just had a funny one posted on our all teams here by one of our team managers about how Waller was commenting that he feels like they keep getting inflation in a quote unquote chokehold and then it slips away from them. And so that seems to be kind of the emerging narrative that inflation temporarily receded mid-year this year, but it isn't permanently been lowered yet.
Good. All right. So anything else besides the Fed announcement Wednesday that you want to keep an eye on, even maybe through the end of the year?
Through the end of the year, I would say this is probably the last really big one. We should get some GDP numbers into the month here to kind of round out the year. And then this Friday, there's a PCE inflation metric. Again, all we've been talking about during this segment here has been inflation. So keep an eye on that on Friday. But really the big one here is going to be the Fed announcement, the rate cut potential, and then any comments Powell makes. The last FOMC meeting was just post-election. I'd be interested to see if he gets any more politically charged lines of questioning during his press conference. I know he stood firm and said he wouldn't bow to any sort of political pressures, but I'm sure journalists will want to press him on that again.
Indeed. Looking forward to it. Okay, great discussion. Those are a few things to watch as we wrap up the year. And now we want to talk a little bit about some pivotal and memorable moments of 2024. And some major themes that we all saw, some of which relate back to our industry. Some are just fun to talk about, and some I think were just major events in the world and in our country that are good to, I think, remember as we get into the end of the year. I mean, 2024, pretty slow in terms of our industry, right? In terms of rate movement and volume. But we did have some major events arise, and we had some common themes that we could talk about. A big one, I think, in our industry, and one of the big themes that we talk about a lot on our podcasts and our webinars and just generally around the desk is we've been wrong all year long, but we've also been right in a lot of areas, which is kind of a weird thing to say, but we'll talk through a few of the items we've been wrong and right about this year, and I think you'll kind of agree.
Yeah, we were looking back at some webinars from January. I think the same talking points are there today. I was thinking about a webinar you and I did and maybe midsummer, where we're talking about we're kind of just waiting for the other shoe to drop, right? We're kind of just a little bit in this holding pattern, wait and see more. And we've been in that really the entire year. Maybe a little bit of clarity going into the year. Certainly the Fed has started cutting rates, but it is interesting that we've been in this wait and see mode for almost a year.
Definitely. Yeah. I don't think a lot of people expected this year to be, as you called it, as quote unquote boring as it may have seemed. I think at the beginning of the year, people were seeing this year as having a lot of potential for being a big inflection point, ratcheting down in rates back down to maybe not COVID levels, but happier times and lower rate environment, see some refi boom. But yeah, as Jeff was saying, I think, as soon as we started kicking the can on rate cuts, I think, there were people in February who were expecting a rate cut in February, and we kicked the can all the way down to September before we saw any sort of change. So I think that's just very conducive to, as we call it, a pretty slow year.
Yeah, we didn't get exactly what we wanted in terms of rates, right? I think we were cheering for a recession, and some folks were calling for a recession to happen in 2024, and that obviously didn't. So that's led to some of the hesitation to drop rates further. Part of the reason that you're not seeing longer term rates drop at all, and probably part of the reason that we're seeing inflation remain above 2.5%.
Yeah, I mean, inflation, say what you will about it, is an indicator of a strong economy. And across the board, maybe there's been some warning signs here at the tail end of the year. But for the most part, the economy's been very strong this year. Obviously, the stock market isn't a gauge for the health of the entire economy. But I mean, the S&P 500 is up, I don't even know, 30% this year.
Setting records.
Keep setting records.
Yeah, just looking at those bullet points from our January webinar a year ago. Economy remains solid. Core inflation still warm. Labor market showing mixed signals. You could absolutely use those right now as well, right?
Absolutely.
Yeah, you could recycle those slides. And the yield curve is stubbornly flat, right? We were all hoping for a bit of a healthier looking yield curve this year, but we're still right about close to zero between like the 2 and the 10 year. Just stubborn.
Yeah, that's maybe one of the most fascinating points out there, right? We just cannot, it points to not clarity in the kind of the long-term outlook, or maybe that is the the clear vision of what the long-term outlook is, but it's interesting to see how flat it remains.
Yeah, it's moving from negative to positive. You normally see that happen faster, and it potentially should have foretold a recession by now and hasn't. It's just been a really slow-moving metric.
The other thing I got to read off that slide is what to watch that we were mentioning in January. Developments around growth outlook and geopolitical risks.
Yeah.
Again, recycle those as well.
Oh boy, we've had some of those. Yeah. A lot of geopolitical changes over the last year.
Right. Yeah. Huge. Again, we probably haven't talked enough about those because we've been so focused on domestic growth, particularly for our industry, but so many things happening in the Middle East, Russia, Ukraine developments, China developments. Be watching. We'll probably talk more about that next week as we look into 2025.
Yeah, but weirdly, the geopolitical events overseas used to have a bigger impact on U.S. markets, and they really haven't seemed to do that this year. So one of the reasons we haven't talked a lot about it.
Right, we haven't had kind of that risk-off play that we usually see with some of these escalations in some of those places.
Right. I mean, just in terms of projections, we looked back at that too. We said in January of this year, where did we see rates? Where did we see volume? And where did the industry see it? And we came in obviously higher in rate and lower in volume, as you would imagine. In the beginning of this year, most projections wanted an interest rate of right around 6%. And as you know, we're about 6.7 right now. And projections for rates next year have also risen significantly. Depending on who you ask, anywhere between 5 and 6% is where projections were for 30-year mortgage rate in 2025. And now you're seeing those projections between 6 and 7, like 6.4 is about the average. So about 100 basis points higher than what we were expecting if you go back to January. And then the year after that, 2026, we're now expecting rates to be still pretty flat to where they are right now, versus projections earlier this year would say that 2026 we should have been in the low 5s, starting to maybe touch a 4 handle. So obviously seeing different outcome right now. Obviously a lot has changed. There's a lot of talk around the new administration and what that might do for things like inflation and rates. So there's certainly some changes that have happened this year to dictate those new forecasts, to the point where volume right now is expected to be 2.14 trillion in 2025, which is fairly interesting to think about, considering we're going to end up about 1.8 trillion this year. But if you go back to the beginning of this year, we were expecting this year to be a $2 trillion year. So continuing to see just numbers come in stubbornly high on the rate side than what projections are, but lower on the volume side. As far as like what we thought the Fed was going to do this year, Alex, how did we come in there? Like if you look at the dot plot beginning of the year versus now, pretty close.
Yeah.
Again, didn't get exactly what we wanted, but
didn't get exactly what we wanted. Like I said, I think people were expecting the Fed to start cutting earlier than they did. I mean, the leaves were falling off the trees before they started cutting rates. But yeah, if you go back and look at the dot plot from the December 2023 release, and then you compare it to the most recent one we have from September this year. If you're listening to this after December 18th, you'll have a December dot plot as well. You could compare, but I expect the December one to look similar. But I think there's two trends you can see. You can see a consolidation of the dot plot. So your most dovish and your most hawkish members have come in. And then I would say on average, you can see that rates are expected to be a little bit higher. I think those are the two main takeaways. So just a consolidation. So it means I would say that there's greater agreement on the FOMC Council of where we are and what is needed from their policy guidance. And you can tell that agreement means they're in agreement that the rates are going to remain higher as well.
Right. All right. Let's shift gears a little bit. What are some other things that happened that maybe indirectly affect our industry, right? There was the NAR lawsuit, National Association of Realtors lawsuit, that was settled in March, I believe, of this year. Already starting to see some effects come from that. I'm sure a lot of you who are originators are seeing, you deal with realtors every day, and you're seeing some changes there in how realtors service clients. And I believe the most recent stat showed that realtor compensation was down pretty materially, around 30 basis points since the settlement.
Yeah, I think everybody knew that was going to be somewhat disruptive. I think there's no explicit path, right? People are trying to kind of forge their own path on how that gets kind of negotiated out, obviously on a deal by deal basis. But, obviously it is starting to have effect, and that does help some of our affordability, right?
Sure.
Decrease in fees leads to incentive to move, incentive to buy. So helps with supply, helps with our affordability issues. So, any bit helps there, at least from, our origination side of the industry. Obviously, realtors probably are not very happy about it. In my mind, I think it makes a lot of sense.
Right.
Another one that trying to help the affordability crisis, helping low-income borrowers, we had in March, we had the first-time homebuyer $2,500 credit for Home Ready and Home Possible loans for very low income borrowers. So, $2,500 is significant, certainly for those very low income borrowers. That was just announced, I think, in the last week or two, that's going to be extended for another year, which anytime that type of thing happens, it basically means it's become essentially permanent. So, make sure, you're taking advantage of that program where possible. There was a lot of discussion around that when it came out, exactly how we were going to implement that. But, it's essentially become close to codified, if you will, where that's a permanent staple.
Definitely, yeah. And when you're talking about the programs designed to help level the playing field a little bit and improve borrower affordability, especially on the lower end, we saw Fannie and Freddie mission scores rolled out in the early summer, May and June. Just two federal programs designed to help incentivize lending in areas down to the zip code, which I think just shows how technology continues to improve and how we're able to really target with a fine needle where we want to improve lending.
Yeah, I think that one's new enough. We're still trying to figure out how to get those incentives down to the borrower, especially when you're looking at income-based adjustments. How can we price that into the front end onto the rate sheet all the way to the borrower? So we'll see how that continues to play out in 2025, but that certainly some good incentives there if we can figure out how to push that all the way through.
Yeah, those of you who are following capital markets, to switch gears a little bit, if you recall, 4210, the infamous 4210 finally went into action in May of this year after roughly a decade of being pushed forward. So that ended up being kind of a non-event, I think, across the industry, give or take a few dealers and a couple of clients. We didn't see much blowback from that. I think we talked about it so much over the last decade that we all pretty much have accepted it at this point. But anyway, it's kind of worth celebrating that 4210 is finally in place. What about some other big events we had this year? We had the Summer Olympics, which is amazing. It's always fun to watch, especially, the U.S., once again, fairly dominant, I would say, safe to say, across the board.
Yeah. USA.
Came out number one in the medal count.
That's right.
But that's always fun. I feel like we still have recordings on our... Am I one of the few people that still use DVRs?
Still have a DVR.
People, yes. Yeah, all right.
I think the rest of us are streaming it, but that's cool.
I'm still getting through the swimming events, so we'll see if I can get to track and field here sometime soon. Always fun. Olympics are fun.
Yeah, feels like it was a long time ago. It was really just August, right?
Yeah.
All these points, I could have sworn they all happened June or later, but seeing things back from March, time flies.
Yeah, it's been a wild year. Even the election seems like it was a year ago. And it's worth noting that the election did happen. It happened about a month and a half ago. Leading up to the election, I think a lot of the anxiety and a lot of the news was around how the election could have been a bit messier and the aftermath could have taken a lot longer than it did, but it ended up somehow being very smooth, which is not necessarily rate friendly, but it was relatively smooth and something that will, we talked about tariffs on the last podcast. We'll continue talking about the new administration coming in and how that could affect rates as we go into 2025.
One thing that did live up to the hype, for me, at least in Texas, was the solar eclipse in April. That was super cool. That was, there's so much talk about that. I was like, this is going to be a letdown. But that was one of the coolest things I've ever witnessed. That was really fun.
Talk about captivating the whole country, or this whole part of the world. From Texas up to Buffalo, there was just a total solar eclipse. It was pretty wild to see and to experience it. Even here in Denver, you got to see a little bit of it with the glasses or the...
It was, it felt like a very strong cloud cover came over all of a sudden.
It's creepy.
It was amazing. The stillness of it all was really cool. Never forget that.
Yeah.
A few major disasters that we should mention domestically. Obviously, the Baltimore Bridge collapse, the Francis Scott Key Bridge. That was this year. Again, that feels like forever ago. Certainly a tragedy, and obviously affected supply issues. We were all very concerned about that. I think ultimately it was a little bit smoother than maybe people thought that would be coming out of that. A big one to talk about.
Yeah, initial projections on that one were pretty dire, but it seems as if other ports, I guess, were able to probably bring on that capacity.
And then, of course, we had the hurricanes, Helene and Milton, this late summer, early fall, also caused major damage, disruption to certain regions, especially inland, which was interesting. This wasn't, these obviously, by definition, these hurricanes come in on the coast, but they wreaked havoc pretty deep into Florida and other states along the southeast.
Yeah, no, the Carolinas were hit especially bad by both.
Yeah, and some of the lowest risk areas, at least by previous measurements, which is also interesting.
Yeah. No, these storms definitely more than just a storm surge along the coast, and then some just because of some pressure patterns, you saw them actually increase in power even once they had made landfall, which was something we don't often, if ever, see.
Creepy. Yeah, just the change in weather patterns the last decade or two have been a little bit creepy.
I think that'll be a theme going forward as well. Again, as it affects our industry, insurance, home values, all these different types of things to watch going forward.
Yeah, for sure. Just migration, with all the types of weather events like fires and hurricanes and floods, just where are people going to be living, after some of the huge migration that happened during the pandemic. Now some of it seems to be reversing itself. So there's definitely a story there that relates to mortgages and housing.
Yeah, I think we could definitely see some accelerations of those trends we saw during COVID of the coast becoming less attractive.
So that's a big theme. A couple other big themes from the year: AI ubiquity. I think, you can't get anywhere. That's going to be on all the end of the year lists. I'm sure AI is going to be at the top of the list for themes. No different in our industry. We've certainly embraced it at Optimal Blue. We're doing some really cool stuff with it. But, obviously there's obviously concerns as well as a cause for job market concern. My take is always don't be afraid of it, run into it on these types of things. But there are some concerns out there. It'll certainly change the dynamics of the job market.
Yeah, I mean, we're all still trying to figure out how to use AI in practical ways, whether it's in our normal, in our day-to-day lives or at work or for our businesses. And as you said, we're doing a lot of things at OB to use AI, and it's still becoming ubiquitous and becoming adopted across the world. And as we go into next year, it is possible that we'll start thinking about and talking about some of the possible negatives in the long term, like jobs, you can get real deep into Terminator 2 type of discussions if you have your tinfoil hat on. But yeah, generally just exciting things happening there. But it wouldn't be a year in review if we didn't mention AI and its upcoming ubiquity and NVIDIA and just everything that was big news around AI this year.
Yeah, I definitely expect in 2025 and moving forward, just because of the pace of technological advancement, I don't think we've had time, especially from a government perspective, to have the ethics conversations yet, or who owns what when it comes to AI with these image generation models, these video generation models. And I think we could see some like you're saying, maybe some backlash on especially on the labor front as jobs could be automated away with it. But I think we're just gonna have a larger conversation about the ramifications, and I think that could lead to some legal developments as well.
Sure. Yeah, some folks have compared it to like the Industrial Revolution.
Yeah.
Right. Where machines started taking over jobs that people typically did with their hands. But we got through that, and there's ways that you can build strategies and social plans around how you navigate that huge shift in the labor force.
Yeah, there was a great comment from, I think they were from HUD, perhaps the FHFA, at the Housing Wire AI conference in July. They mentioned just because there's this cool technology exists doesn't mean it's an excuse to go around regulations. Mm-hmm. For instance, fair lending regulations in this case. So that's certainly something to keep in mind. We've got this cool technology, but we still have to fit it into the framework of what exists today.
Right. Oh, what else? It probably wouldn't be a recap without talking about other themes that wrapped around the mortgage industry. And recapture was a huge story this year. Even though we didn't get rates where we wanted them, we did see rates vacillate at least, late summer, early fall, where the recapture story started to heat up again. There were certainly some servicers this year who were paying pretty heavy prices to accumulate servicing, whether it was in bulk or loan by loan from our clients and anyone selling whole loans, with the thought that they were putting value on these loans with the thought that they would be refinancing them as rates drop over the next couple of years. And obviously we talked earlier in this call, and we've talked over the last few months about how rates have been stubbornly high and are now expected to be stubbornly high for a very prolonged period of time. So I wonder what that story will look like in 2025.
Yeah, it certainly affected the pricing on the secondary market. Like you said, we had some really standout investors that really have put a premium on what they think recapture is worth, and it has affected how loans are sold in the secondary market and how loans are ultimately priced to the borrower because of that. I wonder if they're getting their value out of it yet. I guess remains to be seen.
I think there were certainly some assumptions have changed this year, as everybody knows. All right, let's change gears a little bit. Obviously, a lot has happened at Optimal Blue over the last year. We had a lot of fun events here, a lot of informative industry events that we held. We have our road shows, which we'll continue to do in the future. Appreciate everybody who has attended those. We had our capital markets forums this year as well, which is hosted by our group, the Hedging and Trading team at Optimal Blue. And that will be, the summit is going to substitute as our early year forum next year. So if you have come to our forums in the past, or even if you haven't and you'd like to attend one, the summit, we will have all the same similar sessions at the summit as we would have at a forum, plus obviously the networking events and just a ton more people than we typically have at a forum. So another great event to join here in February. And we have new podcasts.
Of all of those is education is important to us, right? Sharing information, using all this expertise that we have, that our clients have, and aggregating that so that it's easy to learn from each other, easier to become a little bit more educated on the market, how to use our systems, et cetera. That remains a focus for us. And I think we did a good job of it in 2024 to pat ourselves on the back a little bit. And, we'll grow that in 2025 as well.
Yeah, well said. All right, before we wrap this thing up, this is a retrospective on the year, so it would feel weird not to maybe talk about some top music and top movies of the year. Again, it seems like these came out years ago, but this year we saw, if you have kids or you just like, Pixar-style movies, we had Inside Out 2 that came out this year. If you're into something a little more superhero-ish, Deadpool and Wolverine came out this year finally. And we also saw Dune 2. I think that probably tops the charts on almost any website right now. I have not seen either one.
Did you see Inside Out 2?
I did. Yes. In the theater, matter of fact.
Which one was better, the first or the second?
Don't make me choose. I don't know.
I watched Dune 2 on the airplane, and I got to say, I think I would have enjoyed it more in theaters. I think the screen being this big took away a little bit from it, but still, I love the concept and the the world that they've created there.
Yeah, that one was probably better. I saw it on my IMAX. That was probably a better viewing experience than on an airplane.
Yeah, that and some Boeing 737 engines just off to my left side. Yeah,
yeah, a lot like Mad Max too. That was another big one that came out this year. I know the Mad Max franchise in general is one of Jeff's favorites.
Yeah, those are cool ones.
Another one you need to see on a big screen rather than on your phone.
I saw that one on IMAX as well.
Yeah.
As far as music, the top Spotify artist of the year, you can probably all guess who that would be. That was Taylor Swift, if you hadn't guessed. And then someone sent me a text the other day, and I don't know if this was real or not, but it made me chuckle a little bit, so I thought it was worth mentioning that Kirk Van Houten's Can I Borrow a Feeling hit 1 billion listens on Spotify, which I think is just a monumental achievement for Kirk and the Van Houten family.
I had to ask who this was. Yeah, you're going to have to explain this one.
If you're not familiar, Kirk Van Houten is Milhouse Van Houten's father on The Simpsons. And look up his album on Spotify when you get a chance. Just give it a listen.
Apparently a lot of people have, but I'm not one of those.
1 billion. Can't be wrong.
Also of note, Beyonce came out with a new album. Don't forget about Beyonce. I know there's and of course the Taylor Swift and Beyonce tours that propped up our economy for the first half of the year.
How much has the Eras tour created in world GDP at this point?
The Eras tour and NVIDIA are propping up the entire world economy.
Spooky. Yeah. All right. Good. Well, that was a great recap, team. Next week, we'll talk about what we expect in 2025, just to give a little bit of a preview. And obviously, after what we've seen this year, anything can happen. Hopefully, NVIDIA will keep the world propped up, and Beyonce and Taylor Swift will do their part as well. And we'll talk about what we expect for rates, the industry, and the economy.
Yeah, I hope we can do our part too.
That's right. All right. Great discussion about 2024 and looking forward to 2025. Let's close this thing out. Please make sure you register for our summit. And next week, as we said, we will have our last podcast of the year. And that will be, a little bit more of an economic update, but also a preview of 2025. So thank you, Alex. Thank you, Jeff, for a great podcast. And that's it for today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analysis and insights to help you stay ahead. Don't forget to follow us on LinkedIn for more updates and to access our latest video episodes. You can also find each episode on all major podcast platforms. Thanks again for tuning in to Optimal Insights.